The worst thing that can happen to a beginner in the financial markets is not a sequence of losses. It is a string of perfect wins. If you come into this game looking for a strategy that delivers a 90% win rate, you are not seeking an edge. You are seeking an emotional security blanket. And that security blanket is the exact reason your account is flatlining. The retail trading industry has conditioned you to believe that success is a function of being right. They sell you indicators, algorithms, and systems wrapped in the promise of flawless accuracy. But here's the cold reality they keep behind the paywall. An obsession with a high win rate is a psychological trap. It is a mathematical dead end designed to exploit your fear of failure, drain your cognitive capacity, and ultimately liquidate your capital. You are not losing money because your strategy is wrong. You are losing money because you are terrified of being wrong. Let us speak honestly about what happens inside your execution room. You spend hours analyzing the charts before the session opens, you map out your liquidity pools, you identify your key structural levels, and you write down a precise execution plan. You feel calm. You feel in control. Then, the live market opens, volatility spikes, price action moves against your entry, it approaches your stop loss. In that exact fraction of a second, an uncomfortable internal tension takes over your body. Your heart rate elevates, your breathing becomes shallow. The calm, analytical mind that engineered the plan suddenly dissolves. Why? Because your brain treats a financial loss as a literal threat to your survival. To preserve your streak, to protect your ego, and to keep that beautiful, comforting illusion of a high win rate intact, you do the one thing a professional never does. You move your stop loss back, just a few pips. You tell yourself you are giving the trade room to breathe. The market bounces slightly. You feel a momentary wave of relief. But the relief is short-lived. Price turns back around, heavier this time, breaking through your new level. Now you are stuck. You are no longer executing a strategy, you are holding a hostage. You refuse to close the trade because closing it means accepting that you were wrong. It means damaging your win rate statistic. So you sit there, frozen, watching a single losing trade consume days, weeks, or even months of hard-earned profits. When the account finally blows, the realization hits you like a physical blow to the chest. The market did not do this to you. The market is completely, utterly, and indifferently neutral. It has no opinion about your ego. It does not know your account balance exists. The market did not hijack your mouse. You did. You sacrificed your entire account on the altar of being right. Let us deconstruct the brutal mathematics of a 90% win rate so you can see the structural flaw in its architecture. To maintain a strategy that wins 9 out of 10 times, you must alter the relationship between your risk and your reward. Because the market operates on pure probability, a system with a high psychological accuracy almost always demands an asymmetrical downside. In plain terms, you are picking up pennies in front of a steamroller. Imagine a system where you win 90% of your trades. To achieve this, your strategy relies on taking tiny, immediate profits, say $100 per trade. Out of 10 trades, you win 9. Your screen is beautifully green. You feel like a master of the universe. You've accumulated $900. But to keep that win rate so high, your strategy cannot afford to take small losses. Your stop loss must be massive or non-existent to give every trade a chance to bounce back into profit. On the 10th trade, the market enters a structural trend that does not reverse. The steamroller arrives. That single losing trade drops until it hits a loss of $1,500 before you finally cut the cord. Look at the aggregate outcome. You won 9 times, you lost once. Your win rate is precisely 90%, and you are down $600. This is where we must transition from financial capital to psychological assets. Risk management is not an accounting exercise designed to save your money. It's a neurological protocol designed to preserve your cognitive bandwidth. Every time you enter a trade that requires a high win rate to be viable, you place an unsustainable burden on your nervous system. Your brain is forced to operate in a state of hypervigilance. When you refuse to take a small loss, you are actively consuming the mental energy required to find the next valid setup. You are burning your decision-making bandwidth on emotional preservation rather than systemic execution. Professionals don't look at a trade as an identity test. They understand the core law of trading sovereignty. The outcome of any individual trade is completely random and entirely irrelevant. Consider a professional edge with a 40% win rate and a 1-to-3 risk-to-reward ratio. For every $100 risked, the system returns $300 when it's right. If that professional takes 10 trades, they will lose 6 times. Their screen will show a sea of red. To an amateur, this looks like failure. It looks like incompetence. But let's run the mathematical reality. 6 losses at $100 each equals a loss of $600. 4 wins at $300 each equals a gain of $1,200. The aggregate result? A net profit of $600 with a win rate of only 40%. The professional doesn't experience emotional hijacking during those 6 losses because their strategy does not require them to be right today to be profitable next month. They have detached their self-worth from the immediate tick of the chart. They don't view a loss as a mistake. They view it as a routine operating expense. Think of a premium casino. The house does not panic when a single player hits a jackpot on the blackjack table. The house does not change its rules, move its table limits, or get angry at the player. Why? Because they know the underlying math ensures that over the next 100,000 hands, the house edge will express itself with absolute certainty. The casino thinks in aggregates. The retail gambler thinks in individual plays. If you want to stop gambling, you must stop treating your trading account like a knight at the roulette table. To break free from the high win rate trap and join the small percentage of participants that pull consistent liquidity from the markets, you must install an entirely new operating system within your mind. This is the sovereignty framework. It consists of 3 non-negotiable rules of execution that separate the career professional from the reactive amateur. Rule 1. The rule of random distribution. You must accept at the deepest level of your nervous system that any valid trading edge has a random distribution of outcomes over a large enough sample size. If you take 20 trades, you could easily experience 10 losses in a row at the beginning of that sequence. That loss streak says absolutely nothing about the validity of your edge, and it says nothing about your intelligence. It is simply probability expressing itself. When you truly accept this, the urgent need to look at your floating P&L disappears. You stop managing the trade based on fear, and you start letting the market hit your technical targets. Rule 2. The standardization of risk. You must standardize your risk per trade to a level that keeps your emotional volatility at 0. If you are trading a $5,000 account and risking $500 per trade, you are risking 10% of your capital on a single random event. Your brain will inevitably enter survival mode. Reduce your risk to a fixed, uncompromising baseline, 1% or lower. At $50 a trade, a string of 5 losses is a minor operating cost of $250, not a catastrophic drawdown that threatens your lifestyle. You must trade at a size where a loss leaves your psychological bandwidth completely uncompromised. Rule 3. Process sovereignty. From this day forward, you must redefine what a good trade means. An amateur defines a good trade as a trade that made money. A professional defines a good trade as a trade that perfectly followed the process, regardless of that it hit the take profit or the stop loss. If you violate your plan, chase price, extend your stop, and happen to make $1,000 through pure luck, you did not execute a good trade. You committed a catastrophic behavioral error that the market will eventually punish with interest. Conversely, if you execute your setup perfectly, manage your risk flawlessly, and get stopped out for a small loss, you have achieved a victorious execution. Celebrate the discipline, accept the cost, and move directly to the next setup. The charts are not a puzzle to be solved. They do not contain a secret code that will grant you perpetual certainty or protect you from the discomfort of being wrong. The charts are simply an indifferent mirror. They reflect your greed, your impatience, your need for validation, and your fear of insignificance, right back into your face. The pursuit of a 90% win rate is nothing more than an attempt to control an uncontrollable environment. It is the ego demanding that the market conform to its need for perfection. But sustainable wealth is not built on perfection. It is built on the cold, systematic management of uncertainty. When you step onto this path, you must leave the crowd behind. You must accept the vulnerability of a lower win rate to achieve the reality of higher profitability. You must trade from a place of absolute inner sovereignty, acting as a disciplined craftsman who respects the process rather than a desperate gambler hunting for a guarantee. Mastering this psychological shift is the foundational step, but once you dismantle the illusion of the win rate, you will face an even greater hidden adversary, the brutal psychological landscape of the drawdown. How do you maintain flawless execution when you have done everything right for 2 weeks and your account is still in the red? That's the next layer of the game we must conquer. We will deconstruct it in our next session. Stay grounded, stay objective, trust the process.